This mini-lecture introduces the concepts of fixed and variable cost behaviours. Understanding how costs behave in response to certain decisions and events enables us to take control of them because we know how they'll respond to our choice. So the key concepts we will cover off here: fixed costs, variable costs, both of which describe cost behaviour, a linear cost function, which is the algebraic representation of the fixed and variable cost behaviour, and a discussion about the relevant range of activity, which is only there because it tells us how far we can rely on the linear cost function and at what point that linear cost function is no longer representative of what we've been experiencing in our business. To reinforce the importance of understanding about cost behaviour, and as a result of that understanding being able to pull the levers to change things, here's a short list of some of the ways that you as a manager will use cost information. Firstly, you'll use it to control costs. Usually we have to control costs to keep them within budget and to keep them in a level which is consistent with the level of service that we want to provide in our business and consistent with delivering the financial outcomes that the board has targeted and that we have signed up to when we agree a budget. Now the next one goes back to the planning function. If you are going to plan financially and plan which costs you're going to need and incur, then again clearly you need to know what's going to drive those costs in order to be able to predict them. The third one is an accounting regulatory requirement. If your business is one that has inventories, that's stock in order to sell, then there is a requirement that you be able to value that inventory, and the rules for valuing it are quite clear about what costs are included and how they are to be counted. The fourth one is an aid in setting selling prices. Notice that cost is an aid in setting selling price. It rarely dictates the complete answer, and that's because marketers in particular and business managers understand that the setting of selling prices is a response to the market far more than it is a response to costs. Obviously we have to cover costs, but once costs are covered, the setting of selling prices is very much in response to market forces. And the final one that we've listed here is to be able to ascertain the relative profitability of products. Some products will deliver greater profit than others, and if you're a manager and you have to make decisions about resource allocation or marketing strategies, then you'll want to know which are the profitable products and which are the less profitable products. There are two categories of cost behaviour that we're going to touch on. They are a simplification, but for our purposes and for most purposes, it's a very efficient way of understanding cost behaviour, and about 95% of the estimations you'll need to make will be adequately covered by understanding about fixed and variable. Okay, so a fixed cost is fixed if it does not change in response to changes in the level of activity. Now, what is the level of activity? Well, most often activity is measured in terms of either production output or sales output. And either of those describes very clearly just how hard the organisation is working. There are some examples there of fixed costs: rent of your office premises or of your factory, depreciation of buildings, property rates, the salary of administrators. None of those costs will be different whether we produce huge volumes or whether we produce tiny volumes, or whether we sell huge volumes or whether we sell tiny volumes. The contrast here is with variable costs. So variable cost definition: a cost is variable if it changes in response to changes in the level of activity. So considering the same levels of activity that we mentioned when we were talking about fixed costs, we were talking about production output or level of sales. And the examples here are about a variable cost. Could be the raw materials which are used in production, which will obviously vary if production is higher or if production is lower. Sales commission is another example which will vary. If the sales level is higher, then sales commissions paid are likely to be higher. If the sales are low, then sales commissions will be lower or possibly even zero. Now, just to lock in on the terminology here, we refer to the level of activity, whatever it is, and you choose when you're making a cost estimation what is the level of activity, but we refer to this level of activity as the cost driver. That's to say it drives those costs either up or down. Now, somewhere in the middle of this discussion is another type of cost which is known as a mixed cost. And a mixed cost is very simply one which can be pulled apart to show that it has one component which is fixed and another which is variable. And so a very good example there is the commission which is paid to a real estate agent, which is usually based on a fixed component, regardless of how high the sales dollar is, and a commission, a sliding scale, which is likely to go up and up and up, depending on how high the selling price is.